Hi, I'm John Mark Young, and welcome back to the Whitaker-Myers Wealth Managers Question of the Week video. This week's question comes from Lucas in Loudonville, Ohio, and Lucas asks, John Mark, can you help me understand the 4 categories that Dave Ramsey talks about on his radio show and in Financial Peace University: growth, growth and income, aggressive growth, international? I'm having problems figuring out how to incorporate these in my 401k, and I need some help understanding them. Well, that's a very common question we get, Lucas, one that we think is one that your financial advisor or financial planner who has the heart of a teacher should be helping you understand a little bit more about what do those 4 categories mean when I invest in them and how do I pick them. So let's dive in and talk about the 4 Dave Ramsey categories and how those should be defined. The first of Dave's 4 categories is the growth category. Now, in the investment world, these are what we call large cap growth funds. And this would be a company like Google, Amazon, Nvidia is a very popular one. These are companies that have a market capitalization value of more than $10 billion. Now, what do we mean by market capitalization value? Well, that is just essentially the value of the stock times the number of the shares. It tells you how big is the company. How much is it worth overall? Market capitalization, $10 billion or more. And common characteristics of these companies within this type of fund are, 1, they have a lot of transparency. It's publicly traded. And the financial situation of the company is made public and easy to find. You're never going to learn something probably that other people don't know about Amazon, Google, Nvidia. The second thing we would say about these types of companies is they're typically a little more stable than their smaller company brethren. Companies that are bigger in size generally have more of a stable balance sheet. They have more of a stable level of growth that smaller companies potentially cannot provide you. And hopefully the goal with these bigger companies is that there's a level of consistency. Now, there's no perfection in investing, and the market is positive 80% of years and negative 20% of years, and it's positive 53% of days and 47% of days are negative. So don't expect perfection with a growth fund, but the reality is, what would it take for a growth company to go out of business, a Google and Amazon, those sort of places? It's going to take a lot. So these companies would be a little more financially stable than we would say a small company would be, or an aggressive growth in Dave Ramsey's lingo. And then the third characteristic we would say about growth companies is these companies usually do not offer dividends, and instead they reinvest most of their profits back into the growth of the company to help develop and expand their services, their markets, their technologies. And a common benchmark we use for a growth fund is the Russell 1000 growth. Now, one should note that more recently, some of the growth stocks that are pretty popular out there have started to give dividends. Facebook last year, Google this year, our Alphabet, their parent company. These companies are creating so much cash flow that they can continue to make the reinvestments they need to make into AI, into whatever sort of thing that is on the cusp of their industry. And they also have enough cash flow to also pay you out some of those profits as an investor through a dividend. So while it's not normal for a growth company or a growth fund to pay larger dividends, it's starting to become a little more mainstream with these large technology companies that are starting to pay out a dividend. So maybe there's a new category brewing, a growth and income consolidated category. The second category Dave Ramsey talks about is growth and income. So we had growth first. The second category is growth and income. Now, in the investment world, growth and income funds are what we call large cap value funds. Or to say it another way, these are dividend stock funds. These are large, stable companies. And again, stable being a relative term when you talk about investing, 80% up, 20% down, that instead of reinvesting their growth into the company, they will do that a little bit, but they'll offer investors dividends. These are slower growing companies than growth companies typically, and they supplement their slower growth with a share of the profits to you, the investor, hence the dividend. And these companies typically also have a market capitalization of $10 billion or more, and a common index for the growth and income category is what we call the Russell 1000 value. Now, one thing to note, if you watch our What We Learned in the Markets videos, we commonly tell people the category we use to compare growth and income together instead of using an independent Russell 1000 growth for the growth funds, Russell 1000 value for the value funds, is we use a more common benchmark, the S&P 500. Now, if you're going to use the S&P 500 to compare your growth fund, you can't do that. If you're going to use the S&P 500 to compare your growth and income fund, you can't do that. But if I take the average of my growth and my growth and income fund together, that I could compare to the S&P 500. So I've got to use both of those first two categories together, the average of those, to compare to the S&P 500. The third category that Dave Ramsey talks about is aggressive growth. Now, in the investment world, these are what we call small and mid-cap funds. These are companies within the mid-cap world that have a market capitalization. And again, that's just the size of the company, the share price times the number of outstanding shares. So mid-cap companies typically have a market capitalization of between 2 and 10 billion. Remember, large caps were 10 billion and above. Mid-cap companies usually offer investors greater growth potential than large caps over a long period of time, and they have less volatility than small caps, which we'll talk about here in a second. A common benchmark for companies within the mid-cap space is the S&P 400. And additionally, mid-cap funds can be classified into two subcategories: mid-cap growth and mid-cap value, or said another way, mid-cap dividend. As discussed above with the large cap investments, the growth and income, mid-cap growth funds will be investing in stocks that are faster growing companies within that market capitalization of $2 and $10 billion, somebody like Chipotle. And mid-cap value or mid-cap dividend companies will be investing in stocks of companies that are generally slower growing, but are sharing some of their profits with you, the investor, through a dividend in that same market capitalization space of $2 and $10 billion. Then you have small caps. Companies within the small cap space have a market capitalization of 300 million to 2 billion. These companies are looking for younger companies or companies that are rapidly growing, but in that size space. And they typically offer investors good growth potential if you have the right company. However, it offers more volatility than mid caps and small cap companies. A common benchmark for companies within the small cap space is the Russell 2000. And additionally, small cap funds can be classified into two further subcategories: small cap growth and small cap value or small cap dividend. As discussed above with the large cap funds and the mid cap funds, small cap growth will be investing in stocks that are faster growing with that market capitalization between 300 million and 2 billion. And small cap value or small cap dividend funds will be investing in stocks of companies whom are slower growing, but are sharing their profits with you, the investor, through a dividend in that same market capitalization space of 300 million to 2 billion. So if you followed with us there, the aggressive growth space can be split into mid-sized companies or small companies. And then you can further split the mid-size into two subcategories: the growth-oriented mid-sized companies and the dividend-oriented mid-sized companies. And you can do the same thing with smaller companies, the growth-oriented and the dividend. So actually, the aggressive growth in Dave Ramsey's language has four categories inside of it. It's one category that has four. Talk about getting confusing. Probably why you might want to work with a good, experienced financial planner and investment advisor who can help make sure that you're hitting all four of those categories. Because if you look at any chart of how those categories perform, there can be a dichotomy between the best one of those four subcategories and the worst one. I would hate to only had one of those that ended up being the worst when other variations of the aggressive growth were doing well. So you got to be a master of the middle, which is the entire point of the four categories in the first place, being a master of the middle, spreading money out, not putting all my eggs in one basket, dividing my portion to 7, yes, even to 8, as Ecclesiastes 11:2 tells us. And finally, the last of Dave Ramsey's four categories. We talked about growth. We talked about growth and income. We talked about aggressive growth, which gets split into four subcategories. Now we're going to talk about international. International can actually be split into two subcategories. In the investment world, the international funds are obviously those that are outside of the United States when you're a United States investor. These can be grouped into the two categories that I mentioned above: developed markets and emerging markets. Let's talk about developed markets first. These are companies that are located in developed markets, hence the name, and are generally very established and highly industrialized first world companies. Now, what are some developed markets that are not U.S.? Because the U.S. is a developed market. UK, Australia, Japan, and Germany are some of the major ones. Developed markets usually have a more stable political and financial position and have easy access to the capital markets, which allows them to have a lot more publicly traded companies. A common benchmark used to assess performance within the developed market is the MSCI EAFE index, which is the index that we constantly quote on what we learned in the markets this week. The second half of the international market is what we call emerging markets. These are companies located in emerging markets. Again, hence the name. Have you noticed the theme here? Developed markets are companies within developed markets, developed countries. Emerging market companies are in emerging market economies or countries, and they're considered to be between the developing and the fully developed economies. These markets are usually harder to get money in and out of and can have high political volatility. Countries that would be an example of an emerging market are India, Brazil, and China. And a common index that's used to measure the performance for funds within emerging markets is the MSCI Emerging Markets Index there. So the international markets can be split into developed and emerging. As we tell our clients, we primarily really like the developed markets. However, there are emerging markets that tend to be attractive to us. You just have to be highly particular about what emerging market you think you'd want to go into and have a very strong case for the investment thesis and the growth thesis of that market. So within developed markets, a broad basket is usually pretty good. Within emerging markets, very tactical selection of what countries you want to go in our opinion, is the right way to approach that half of the international markets. One thing to keep in mind when you see a fund that says it's a world or a global fund, that typically includes international and US. Now, when you're investing in the Dave Ramsey lingo, you do not want to have a world or a global fund. That's actually cheating. Why is that cheating? Well, because you're getting US exposure, which over the last 10 years, the US stock market has done better than most international markets. And so it would make my international fund look better from a performance standpoint, but I'm not getting the diversification benefit of why I'm even trying to invest in the international markets, which of course is because there are periods of time where the international markets are the best place to be invested. When I started my career in 2007, during 2007, that decade prior, the international markets were the best place to be invested. And had you not had international investments, your performance would have seriously lagged those of your peers that did have that exposure. The last 10 years, it's pulled down the performance a little bit more, but everything's cyclical, which is why you, again, want to be a master of the middle. So when you go into a global or world fund, what you're doing is you're tricking yourself into thinking, I'm getting my international exposure and improving my performance. We would say the way to improve your performance, again, is being very particular on the international side about country selection. And then you can do that and usually keep pace with diversification benefits and not having my performance lag so much if the international markets go down. Now, of course, there's no guarantee in investing, and past performance is not indicative of future returns. So you have to be careful when you do that kind of stuff. But again, international, you want it because it's different than the US, and there's periods of time, including the decade from 2000 to 2010, where it was one of the best performers of Dave's 4 categories that he talks about. So that was a primer on the 4 categories that Dave talks about, Lucas. Hopefully it was helpful to you as you try to think about how you should spread your money out within your 401k there. And if we can be of help to you, you can go to the comment section of this video where you can schedule a meeting with any of our financial planners or coaches. Our coaches help you in baby steps 1, 2, and 3. They'll help you get out of debt, stay out of debt, live debt free, hold you accountable to your budget. Or if you're in baby steps 4, 5, 6, you can meet with any of our financial planners who would be more than happy to help you get started on your retirement savings strategy, help you build for your kids' college, as well as help you get a plan to pay off that mortgage so you can get to baby step 7 where you can live and give like no one else. Thanks so much for watching this week's video, and don't forget to hit the like and the subscribe button. That helps us out so much. Thanks so much.